Hi, Brock Vandenberg, president of Talamar Financial and fund manager of Talamar Income Fund 1. One common question that I get from investors is, how does an investment in a mortgage fund differ from other traditional investments? In this video, I'm going to explore what it means to invest in a mortgage fund, how a mortgage fund is structured, and how it compares with other traditional investments. A mortgage fund is simply an investment in a portfolio of mortgages. When you invest in a mortgage fund, you are pooling your money with other investors, and then those funds are then lent out to borrowers using real estate as collateral. I always make the comparison of when you deposit money in a bank. The bank makes money by using those funds to make loans. The income generated from that is then shared with the depositors in the form of interest income. Just keep in mind that when you deposit your funds in a bank, they're most likely insured by the FDIC. With a mortgage fund, investors earn interest income or dividend income depending upon how the mortgage fund is structured, from the payments made by the borrowers on the loans in the portfolio. Those payments are then distributed to investors monthly, quarterly, or annually. In our case, distributions are made in the form of a dividend and are paid monthly. One of the advantages of a mortgage fund is that it is a diversified investment. Because you're investing in a portfolio of mortgages, if one loan defaults, you would still earn income from all the other loans in the fund. Second, a mortgage fund is secured on the underlying real estate securing each loan. Again, if a loan were to default, the mortgage fund can foreclose on the property securing that loan and get repaid its original principal and outstanding interest. Third, and one of the biggest advantages that is often overlooked, is that investors can reinvest the distributions and earn compounded interest. And fourth, if the mortgage fund is structured as a real estate investment trust, the interest income earned by the fund is distributed in the form of a dividend that qualifies for a 20% tax deduction. There are risks in a mortgage fund, though, and not all mortgage funds are the same. First, your income is dependent upon the borrowers, each making payments on each of their loans. If a large percentage of the borrowers stop making their payment, the result would be a drop in the income of the fund. Also, if the value of the underlying real estate securing the loans falls below the outstanding balance of the loan, often referred to as a loan that is upside down, the fund may not be able to recoup its original principal and outstanding interest. This could result in a loss to investor capital. And finally, mortgage funds can be relatively liquid. However, if there's a large number of withdrawal requests in a short period of time, your ability to withdraw your funds may be delayed, similar to a run on a bank. When investing in a mortgage fund, it is important to understand the type of real estate securing the loans in the portfolio. I focus on funding residential and multifamily properties in core urban markets because I feel that they offer the best security during recessionary periods. No matter how bad the economy gets, people still need a place to live. Compare that to a mortgage fund that may focus on office properties or properties in rural locations, which would be much more likely to be negatively impacted during a recession. So how does a mortgage fund compare with other traditional investments? First, an investment in a mortgage fund is a common investment, especially for investment banks and private equity funds. However, it isn't until recently that individual investors really had access to these types of investments on a large scale. Investment banks and private equity funds like these investments because of the sheer size of the industry. The private lending industry is a multi-billion-dollar industry that offers consistent monthly income and has the security of real estate. For mortgage funds such as ours that offer short-term loans, we can also capitalize on rising interest rates. As rates go up, so do the rates that mortgage funds charge their borrowers, which result in a higher return to the investor. And because mortgage funds can be structured as a real estate investment trust, such as ours, they qualify their investors to earn a 20% tax deduction on the dividends through the qualified business income tax deduction, commonly referred to as QBIT. So let's compare an investment in a mortgage fund to an investment in the stock market. One of the biggest reasons investors decide to invest in a mortgage fund over the stock market is the volatility. Many investors don't want to worry about the daily ups and downs of the market. They don't want to wake up to one morning to find that the market crashed because of a natural disaster or geopolitical conflict. They prefer to know that every month or quarter, they're going to earn a distribution that will be deposited into their bank account or reinvested into the fund. Another comparison is investing in real estate. By owning real estate, investors can earn long-term appreciation and rental income. However, owning real estate comes with its hassles, such as property management and tenant management. Few investors want to deal with a leaking toilet or a deadbeat tenant. The mortgage fund, on the other hand, offers investors the ability to invest in real estate, but without the hassles of being a property manager. For investors that live in a high-cost area, a mortgage fund doesn't necessarily require such a large upfront investment. And lastly, a mortgage fund is much more liquid than owning real estate. With a mortgage fund, you can simply sign up and start investing versus real estate, which requires you to hire an agent, identify a property, and then get financing for that acquisition. And don't get me started when it's time to sell. Another traditional investment that a mortgage fund is compared to is the interest earned in a savings account or treasury bond. Though rates have climbed considerably over the last year, many mortgage funds that focused on short-term loans have seen a significant increase in the return to their investors. A common theme among investors that invest in a mortgage fund is that they're looking for an investment that offers consistent monthly income, the security of real estate, and can offer a tax deduction on the distributions. They're also looking for an investment that is liquid and offers the ability to increase or decrease their investment very quickly. If you liked this video, please consider giving it a like and subscribing to our channel. I post a lot of content on the mortgage fund industry and real estate investing in general. Also, if you're interested in learning more about our mortgage fund, I've included a link below to our executive summary. And I want to finish by saying thank you for watching.